Just give me a second. There we go. Okay, so it's recording now. I just want to make sure it's recording. Okay, so cost of capital is really the cost that you incur to raise any capital. Specifically with regards, let's say, for example, a loan. So you had pay interest on this loan. That would be a cost that is attached to this capital, or you expected to pay dividends to shareholders. That would be a cost attached to raising that sort of capital. And what we do is we're calculating it. And now with any organization, we have like a mixture. We have like where you get money from loans, or you get money from shareholders, investors, and you get ordinary shares and preferred shares. It's always a mixture. And those things are not always at the same cost. So as we will see later with the weighted average cost of capital, we need to establish what is the true cost in terms of the capital that we've raised. Okay, so the cost is the price. How much do we actually pay to raise that? And then the capital is the money, the finance that we're receiving. And the cost of capital will be the price to raise the finance. Okay, so the one is, on the one hand, we have debt. On the other hand, we have equity. Okay, so all capital is raised with a combination of the two. Sometimes the organizations will have more debt than equity, and sometimes they will be predominantly equity finance. So that mix can really differ across the different companies, and it is how you as a financial manager need to decide what is the optimum mix and how you're going to finance it. Okay, so with debt, we're looking at bonds and loans and overdraft, everything that's normally got an interest rate attached to it. And with equity is where we have investors, so people that buy shares, invest in your company, they give you money, you give them shares, you give them dividends, and then with the debts you give them interest whilst you pay back the capital. Okay. So the pooling of funds, this concept is basically where we draw all the finance, all the sources of finance, we pool it together, and then when we do new investments, maybe we want to build a new factory, or we want to expand, we might build a new line, or whatever investment we want to make, we will take it from this pool. So the money comes from different sources, but we're using it. It's the same concept of, you think about it, if you earn a salary and you have 2 or 3 other incomes, it all comes together. It doesn't matter where the money comes from. You use it for the same purpose, and it's irrelevant in that case. Okay, so we want to, as a company, you would look at what is an ideal capital structure, or a target capital structure. You don't want to fund everything out of debt. I mean, that can be really expensive at the end of the day. And, you know, you want to have a good balance to get the best out of your financing. You want to be able to do the investments that you want to do, but you don't want to end up not being able to afford them, okay, or have a massive amount of risk. So when you look at it to calculate the cost, you look at weighted cost of capital, average cost of capital. So that is the cost that we measure, instead of just looking at the costs for each of these individual sources. So the cost of raising finance. So we look at a rate where we can see, does this investment give us a worthwhile rate or an unworthwhile rate? And is it the cost of capital, is the return good enough? And then this is how we decide. And then the 3 components that we typically look at is the ordinary shareholders' equity. So that's equity financing, preference shares, that's also equity financing, and debt. Okay, so those are the 3 that we're going to be dealing with in terms of what we're looking at here. You could also, if you make it more complicated, even with the debt, you could have it from very different sources as well. They don't have the same percentage attached to them, but for the purpose of this module, we're going to be looking at these 3. So the cost of ordinary shareholders' equity. Ordinary shareholders, these are the guys that invest in the business, in the company, but we don't pay them a fixed dividend. That you go to the board, and then they decide they're going to declare a dividend in a particular year based on the profit, and then they get a dividend, or they may not get a dividend. Okay, it's an expectation, but it doesn't mean that they will actually pay it. Sometimes they also retain some of the money, and they only pay a percentage up. Where with the preference shareholders, they get a fixed percentage every year. So they can basically bargain on it. So we can calculate the cost of equity using two formulas. One is we can use based on the dividends that we're forecasting. You can forecast the dividend in the forecast. The dividend you can forecast based on your profit projection. You can say, we think we're going to make so much profit. Of that profit, we will retain a certain percentage. We also have to obviously pay the preference shareholders, but what is it that's remaining we'll pay as dividends. Okay, so you can use that to see what percentage that cost will be. And the other one is the capital asset pricing model, or the CAPM. Yeah, so every company's got a different policy with regards to dividends. Some would have more of an expansionary policy where they would say, we don't want to use all the dividends now. We don't want to use all the profits and pay it to our shareholders. We're in a process of growing our business. So maybe we want to retain a lot more, as opposed to paying it out to our dearly beloved shareholders. Or they say, no, we're already in full bloom. We're at maximum capacity. We don't think we're going to expand. We're just going to keep growing. So we're going to keep the shareholders happy in this case, which means they will pay more dividends. Okay, so if we calculate based on the dividends, so if we go back to the previous one, we see we calculate either on dividends. Let me just put my pen on here. There's a point. So here you've got the dividends, the other one's the CAPM. So if we just look at the dividends, there are two modules that we can use. It's the dividend valuation model, and the other one is a dividend growth model. Okay, so there are two different models. And with the valuation model, we simply say that this is the dividend, what we think we're going to be paying in perpetuity going forward, as a percentage of the market price of the ordinary shares. So as you can see in this formula here, these formulas are also given. So you can see that if you look at if you're going to get a test or exam or whatever, in the appendix, these formulas are given, but you need to know them, because it doesn't mean I'm going to put down the heading. I'm going to say this is a dividend valuation formula. You need to be able to identify it and say, I know this guy. Okay, this is KE. It is a cost of equity. You see there's a little E there. Okay, so it's not D, which is debt, so it's equity, and then it's D0 over P0. So you need to understand these abbreviations and what it means. The 0, the D obviously means dividend, but the 0, it means now, today. Okay, if this was D1, it would have meant dividend for next year. If it was dividend, D2 would have meant dividend in 2 years' time. So that's what that 0 stands for. The P is always the market price for ordinary shares. And again, this is now, today. Okay, and here's 0. Okay, so K is the cost, E is cost of ordinary shares. Okay, so you get a KP, a KE, and a KD. So KE is the cost of ordinary shares. Okay, so in this example, if we use this very, very simple, Constant Limited has R1 par value ordinary shares in issue, and the ordinary shares are currently trading at R4.30. Now you can see that R1 par value, that means this is the value that the guys that invested in this company, they paid for it. They paid R1 for it. But now, currently, it's trading at R4.30. And a dividend of 30 cents per share has just been proposed. So we use the R4.30 and 30 cents. So you can see D0 over P0 is also expressed as cents. Okay, just note that. So we use it as cents, 30 cents over 430 cents. It gives us almost 7%. Okay, so then the next one is what we call the dividend growth model. So in this case, we assume that the dividends that we pay out is expected to increase going forward at a certain percentage. So if you pay like the 30 cents there, we say no, we're expecting it to grow by 5% per annum. Okay, so we have a factor that we include to say that we need to consider that 5% or whatever the growth is. Okay, so the formula, you can see there's also the D0 with the P0, but we add to the dividend, we add 1 plus the growth. Okay, so if it's 5%, it will be times 1.05. And then at the end, we add growth again here. Okay, so this is a formula for the dividend growth model. Just know the difference between the two. Okay, so in this example, it's, I said the dividend will increase by 10%. So it's the same. And the market value is 400 cents. You can see here. And then there's a dividend of 30 cents. So it's times 1.01, because it's 10%, plus 0.01. And then the cost of ordinary shares is 18.25%. Okay, so these are easy to calculate. There's nothing difficult about them. You just need to know the difference between the two. The one is growth, the one is just in perpetuity, so where you assume the dividend is the same. And the disadvantage of it is that it can't be used if a dividend is not paid. Okay, so if there's no dividend, you cannot use it because, as I mentioned earlier, it is possible that no dividend is paid for a particular year, and it doesn't consider any risk. And with a growth model, you assume a constant growth rate, which is in reality mostly not the case. You'll find that growth tends to vary. Could be 10% the one year and 8% the other year and 20, and could even be -5 or whatever. So it does change. And then the other one is the capital asset pricing model, the CAPM. So the first ones, the two that I mentioned before, they're for the dividends. This is for the CAPM. And as you can see, it's also the cost of ordinary capital. So it's also KE, but KE here is now different. Okay, so KE is now the risk-free rate of return plus beta, which is a beta coefficient of the share times the return on the market portfolio less the market, the risk-free rate of return, which in essence is the market risk premium. Okay, so for a risk-free rate of return, this is typically if you invest in anything that's got to do with government, which is very safe, you'll get a certain percentage. If you invest in something that's more on the market, you'll maybe get a higher percentage, but there's a bigger risk involved in that. Okay, so the beta coefficient is basically, it's not like a standard deviation, but you can call it where you have, it's like a variability. So how likely is it that things can differ from what we see here in terms of the risk-free rate and the market rate? If beta is 1, it means it's more than likely it will be the same. If it's either more than 1 or less than 1, it can vary. So if it's more than 1, it means that it is likely that it can be more in terms of the market risk premium, or if it's less than 1, it's likely that it can be less. Okay, so if you can see here, this one has got a beta of 1.3. So the question is, there's a beta of 1.3. The expected return on the market portfolio is 16%, and the risk-free rate is 8%. Okay, so the cost of the ordinary shares is 8% plus the beta times the risk premium, which is a 16 less the 8%, and that gives you 18.4%. So you can see this beta number influences this cost of the, so the higher this number, the higher the cost will be. Okay, so in module, you're not required to calculate beta. You can calculate beta on a certain formula, but this is not to be taught here. We do it on level, but typically you'll be given these numbers. Okay, so you just need to know which ones to look for. Okay, so this one obviously incorporates a risk where the dividend methods do not, and the dividends are not required to estimate the cost of equity, so you don't need dividends. You need a beta coefficient though. If you don't have it, it is difficult. And the return on a market portfolio, and this is only for a single period. Okay, we don't look forward into the future, so we're going to look at one period. Okay, so this is now cost of ordinary shares. We now go to the cost of preference shares, which is related, which is basically the guys that get their dividends on a regular basis. So if you're preference shareholders, you get as 5% or 6 or 7 or 8%, depending on the preference shares that you purchased, and you get that consistently. Okay, they're not deductible for tax purposes, and the calculation of cost of preference shares depend on whether preference shares are redeemable or not. Okay, so if they're non-redeemable, we use perpetuity principles, and if they're redeemable, we use annuity principles. Okay, so for a non-redeemable preference shares, okay, which means it goes on into perpetuity. We don't redeem it after so many years. It's non-redeemable. So you can see this formula looks very familiar. It looks the same as a KE one, and in fact, it is almost exactly the same. So KP, you can see this P here is for preference shares, is your dividend over your market price. So it's exactly the same formula, but just for the preference shares. Okay, so this is if it's in perpetuity, non-redeemable. Okay, so you can see, in this example, non-redeemable limited as 9% non-redeemable preference shares in issue, and the preference shares have a par value of R1 and is currently trading at R1.08, and calculate the cost of preference shares. Now the dividend that you have to pay is 9% of the R1. No, not 9% of the R1.08. So you're obliged to pay 9% on the par value, which is R9. So it's R1 times 9%. Okay, so which is obviously 9 cents over 108 cents, and that gives you 8.33%. Okay, now redeemable preference shares. Now that's a different story. Okay, so we use redeemable preference shares when we know we have to redeem that share in so many years, and we need to establish using time value of money principles. Now, this is why time value of money is important. It's not only important in Unit 2, it's important here, and it's important going forward as well, especially with investment appraisal. So you need to understand your time value of money. Okay, so your present value, in this case, is the current market price of the preference shares. The future value is the part value of the preference shares at redemption. So how much is it that you have to give back to them? And the number of periods until the preference shares are redeemed, that is N, so how many years left? And the gross, the dividend paid and the par value of the preference shares, that is the payment, okay? And then the cost of preference shares, that's to be calculated. So you want to calculate I. Okay, so you've got present value, future value, N, and payment. Okay, redeemable limited has a 9% preference share in issue. 9%. The preference shares have a par value of R1. Okay, so you immediately know that the payment is 9 cents. Okay, so every year you have to pay 9 cents. Currently trading at R1.08. So the present value is R1.08, and the preference shares are redeemable about par in 5 years. So N is 5, par is 1, and your answer is 7.05%. Okay, that was preference shares. Now we're looking at the cost of debt. So that is what the company lenders demands on new debt. If you take out a loan, you pay interest. And you can look at it looking at current rates, interest rates in the market. And then you've got difference between cost of preference shares and cost of debt is that interest on debt is tax deductible. Okay, now the reason why we mention this is that if it's tax deductible, it means that you will only pay the after-tax cost of the interest. Okay, so with preference shares and ordinary shares, you don't, but with with debt, you do. Okay, so dividend on preference shares is not tax deductible. Okay, so it's only with debt. So now for KD, so we had KE, we had KP, we now have KD. We see that the difference between this one and the two previous formulas is that you deduct the tax rate from 1. So if the tax rate is, I'm just going to give a round number, 30%, you're only going to take the interest rate times 100 less 30%, which is 7.7, and you're going to divide it by the market price of the debt. So it means that it reduces the cost of your debt because it's tax deductible. Okay, so if we look at an example, consider debentures. Debentures is a type of a loan, and with this non-redeemable debentures, it's a par value of 100 Rand. Okay, so it's 8%. So it means we have to pay 8% interest, okay, every year. So it's 100 Rand times 8%, and the tax rate, the company tax, is 28%. So we say 1 minus 28%. Okay, so which means divided by the debentures that's currently trading at 90 Rand, which gives us 6.4%. Okay, so the important one is to always multiply by this. So there's 1 less point, it's actually 1 less 0.28. Okay. This is now non-redeemable. Okay, so remember now for preference shares and for debt, when we have non-redeemable, we always use these principles. When something is redeemable, whether it is for preference shares or whether it's for debt, we use annuity principles, which means we have to get out our financial calculator. Okay, same story. Present value, current market price. Future value is the par value of the debt. That's actually not DEPT, it's a DEBT. Okay, which we have to consider, and then the number of periods until the debt is redeemed, and then the payment, and then the cost of the debt to be calculated. Okay, now it works the same. It works the same as the preference shares. The only difference is here again. Once you calculated this payment, you need to multiply it again by 1 minus 0.28. You see, it is 8 Rand, but the after-tax cost really is only 5 Rand 76. Okay, so if you punch in these numbers, you get I is 9.18%. Okay. Let's move to weighted average cost of capital. We've now calculated cost of ordinary shares, cost of preference shares, cost of debt, all those goodies. Now we want to calculate what is the average cost of capital. Okay, so it's the overall return that the entity must generate on existing assets to maintain value of ordinary shares, preference shares, and debt. And each one's got a different cost. Okay, different level of risk as well. Debt is the cheapest sources of finance. It's got the lowest cost of capital. Preference shares is the second cheapest, and ordinary shares most expensive. And they also bear the most risk. Okay, so if a company also gets liquidated, it's always you pay the debt first, then the preference shareholders, and then you pay the ordinary shareholders. Okay, so you calculate these costs of finance like we've done now previously, and then you use market values that should be used, but you can also calculate it on book values. But generally, market value is the correct one. Okay, so to do it, you can see here we've got three components here: the ordinary shares, preference shares, and debt. KE, KP, KD. Then the value in terms of the rand. How much is it that we actually raised? Okay, so if the majority of your debt comes from ordinary shares, obviously the percentage that you've got here will weigh more than something if you only have a very few preference shares. It's just logical. Okay. So if you want to calculate the weighting, you calculate whatever the value is divided by the total. So if this is 50%, it's 50%, or maybe 30, and then that one is 20, and it all adds up to 100. Okay. And then you calculate the after-tax cost multiplied by the weighting, and then you just add it up. Okay, that's no rocket science. It is a case of weighting them correctly. Okay, so KE cost of ordinary shares, KP cost of preference shares, and then the V's are the values. Okay, so the higher the value relative to the total value, the more weight it's going to carry. So it assumes that finance is added to a pool of funds. They're not kept separately. That's why the pooling of funds is different to if you had to put it in a little bit of boxes. Okay, so we use the weighted average cost of capital. We'll see in, I think it's Unit 8, where we look at the investment structure. In new investments, we use that number to calculate if the investment is worthwhile. It assumes that the capital structure won't change. So what you see now, this is what you're going to be using for your forecast. And then new investments do not have a significantly different risk profile to the existing investments, and all cash flows are constant perpetuities. Okay, so there are some assumptions that we need to make. Nothing is ever, it's not foolproof, but these are what we do. Okay, so we should only invest in a project if the return will exceed the weighted average cost of capital, which we'll see later. And new investments are financed by new source of finance, and the weighted average cost of capital includes this cost. It reflects the entity's long-term future capital structure as well as the cost of capital and the appropriate discount rate to be used for investment decisions. Okay. Marginal cost of capital concept is defined as the cost of raising the next rand of capital. If an entity is considering a large investment that could significantly affect its current capital structure, then we can't use the weighted average cost of capital. Then we need to use marginal cost of capital, because maybe even if we only have 5% debt, we are forced to use debt going forward. We cannot use a weighted average cost of capital because it does not accurately reflect what the cost of debt is in this case. Okay, so there's a difference between weighted average cost of capital and marginal. Weighted is what you've got now as in a pot, and then the marginal is what you would need to have these additional funds. Okay, so in conclusion, cost of capital is a rate of return that an entity provides the capital required and the funds that are provided. Cost of capital relating to investment depends on the risk of that investment. Okay, so it depends on the use of the funds and not the source. And when a suitable project is identified, the investment in the project is financed from pool funds rather than by a specific form as finance. Okay, this cost of capital is ordinary shares, preference shares, and debts. We can use either looking at dividends or the capital asset project model. If we don't have dividends, and we can look at a constant dividend, or we're looking at dividend growth. We know that CAPM incorporates risk, and there's a beta coefficient. And then preference shares, we know that one is not deductible for tax, so you don't need to consider that effect. If you look at the cost of debt, you need to deduct the effect of taxation, 1 minus whatever the tax rate is, And then the weighted average cost of capital is basically just all them together. Yeah, marginal cost of capital, incremental cost. And that's it. If there are any questions, you're welcome to either direct message me or email me or schedule a meeting or whatever. Yeah, and then we're all good. Thank you very much for your time.
Thank you, sir.